Hello traders, welcome to the next section of VWAP. I know the theory was incredibly heavy and I know it says theory right at the top, and I don't want you to get worried and think, oh my god, more theory. What it is basically I was reviewing the theory section, and I just wanted to make sure that everything that I wanted to say came across, and I was pretty happy with it, to be honest. On reflection, I think I covered everything I wanted to. Um, but what it is it's really important that you understand, how do institutional investors actually use VWAP to trade. And what I realized is a golden opportunity for me to show you that, but also to solidify and summarize some of the things that I was saying in the sort of theory section, just to make sure that everyone got it and understood it. So I'm kind of just going to combine those things together very quickly, but this is very much a task section. You'll be glad to know. I want you on the charts. I want you after this to be doing some things, and it's really going to help you understand what I'm trying to convey. And again, I just want to say, and I know I said it before, look, I understand, right, the theory in the previous section, it was heavy. Some of you probably understand probability distributions and you might have got it fairly well. But those of you that don't, I don't want you to be disheartened and think a lot of maths going on and too much statistics and this and that. It's not, all right? Same as I said in the stage one probability section. Guys, just get the gist of it. That's all. Just don't use it as a pure indicator. That's all. And I meant that when I said the maths. You don't need to understand it to a deep stage. It's obviously important for completion that I show it here, but as long as you get the gist of it. So that's why I thought when I was reviewing it, I realized, it was quite detailed and in depth. I thought, let me just summarize things. And as long as you take away about 90% of what I'm going to say, you'll be all right. Just don't take away like 10% and just treat it as some lines and Envy says this is what I've got to do, so I've got to do it. Try and um, really get a feel for what the VWAP is telling us, um, because that's going to benefit you. And look, the final thing I'll say is, and I don't want to keep repeating the point, is that, and I said it before, if you don't get it straight away, it's fine. It's something I want and expect you to develop over time. Okay, so reason I'm saying all of this, where I'm going over some of the statistics and the maths, is just because when you're actually on the charts over the next few months, this is where I want you to end up. It's not necessarily where I want you to be by the end of this module. Even if you get 5-10% of it right now and you work towards getting a larger chunk of it, 90% or whatever, over the next few months, brilliant result. That's all I'm saying. Keep revisiting this. Just don't obviously fall into the trap, as I keep saying, of just treating it as a indicator. And hopefully over time, um, you'll be able to develop the same understanding that I've been fortunate enough to develop. And like I said, at the end of the day, this is the honest truth. When I was taught this stuff in an institution, it just wasn't explained. And this is one of the top institutions in the world, two of them. This was not explained to me in this way. They just assumed, I think, that um, maybe I knew it somehow or whatever. But I'll be honest with you. Um, you may think this is far fetched, but honestly, it's true. I don't even think a lot of institutional investors or traders around me really understood this properly. Um, and they were kind of winging it. So, at the end of the day, that's why I say, even if you don't get 100% of what I'm talking about, you're okay. But try to get at least 70, 80, 90% over the next few months, so you can really understand, and it will help you. You can understand what VWAP is. So, I already said the VWAP, essentially, it is volume profile, but it shows the evolution of volume profile. But what I really want to move on to now, and the task, and the thing is, we're obviously going to try and look at how do we use the VWAP to trade. Well, what it is the reason why VWAP is so helpful, and I've talked about it being intra-period, is it's really showing us how the profile is developing throughout the day. And what that does is it helps us identify people in industry and in the market profile books I told you guys to read about. They do call it day types, and that's okay. There's nothing wrong with that. It's actually pretty fair reflection. That VWAP will help you determine the day type. So if you think about it, it's really useful because it can give you clues as to, are we going to be in a balanced day today? Are we going to be in a, I call it imbalanced, obviously, as you know, but if you look, I'm going to start to introduce the word trend here, but be very careful. You know, I've mentioned it before. I don't mean it trend in the way of retail. I actually mean it imbalanced, as in value is moving away from current fair value and we're seeking it elsewhere. But it's such a mouthful for me to keep saying that. I'm happy to use that word trend because ultimately it's just the market is obviously moving away from balance. So, and as you'll see, I've talked about rhythm and acceptance, right? And this is very much part of context. And you'll see when we talk about weekly, monthly, quarterly, yearly VWAP, this is going to be absolutely crucial because you're going to see as the week develops, the month develops, the quarter develops, the year develops. We want to be able to see what's the market condition year to date, month to date, quarter to date. And I'll tell you why that is obviously because of different types of investors, etc. And we'll get into that because obviously everyone's got different perceptions of value. The reason I mention that here is because what I show you here about day types, you see, it's called day types, but the reality is the reason I don't like that word is because it is so applicable to the week, the month, the quarter, the year. Why call it a day type? It's more just type. That's all it is. It's rhythm. I like to call it what's the rhythm, the market condition. That's what I prefer to call it. So I'm going to write it here, market condition, and then combined with the rhythm. Okay, and this will make more sense as we go along. Market condition I've already talked to you about, balance or imbalance. So that is essentially, we can call it the day type. People call it day type when they're talking about day VWAP, but like I said, it can apply to the week. Is the week balanced or imbalanced? See, we call it week type rather than call it week type, month type, whatever. Just like to call it the market condition for the week, for the day, for the month. So you can use these words interchangeably. Rhythm is also something I'm going to introduce here because I talked about acceptance and rhythm. Rhythm is absolutely crucial because I want you to develop an understanding of rhythm, again, on the day, the week, the month, the quarter, the year. And the reason I'm mentioning all of this again is because basically everything I show you here, it's going to apply to the weekly VWAP, to the monthly VWAP, quarterly, yearly. We don't look at them that differently. Essentially, we're going to look at them in the same way that I'm about to show you. So basically, I've talked a lot, but it was important. I said all of that because I want you to get a feel for what I'm going to be talking about in this section and ultimately what understanding I want you to develop in the task. So, like I said, what I want to do is I just want to quickly solidify some of the things we said in the last section and just make sure that it was well understood. Now, what it is I'm going to approach it from a point of view of how do we actually use this thing to take positions and actually think about opportunity, right? So what it is the VWAP, as I explained in the last section, is telling us the mean, right? So over here, okay, in a perfect distribution, which isn't always going to be the case, let's say that's going to be the VWAP, but that's not where we actually started the day, right? This is the end profile. This is almost like a previous day's profile, a previous month's profile, a composite profile, or whatever. Actually, what's happening, as I said, is the profile is developing throughout the day. So here we're seeing a balanced day. In a balanced day, what typically happens? Well, a balanced day follows a sort of a balanced distribution, and we saw this with the heights of males and all the stuff we were talking about in 1.4. So essentially what's happening is early on in the day, right, we're going to start off almost in a balanced state like that. And the mean is going to be there, right? We can almost say that's the VWAP. Then as the day develops, and you'll see more trades come in. What is happening here? Market orders. Can you see we're just building on top of that? Where's the next VWAP going to be? It's going to be in around the same area. Then we're building as more. Do you see it's a balanced day? Then we get more, right? Now we can split this out into, initially it looks like that, then we get more volume, then we get more volume. Do you see? Rather than me having the VWAP there, VWAP there, VWAP there, and having to see all three, and at the end of the day, I could keep drawing I could have hundreds of these going side by side. Like I said, it will take up my whole screen. It's not realistic. I want to see how did this develop throughout the day. Let me just take one measure with obviously the standard deviation, which I'm going to come back to in a second, and just join it up. So that's what's happening. As the profile is, you see more volume builds, then we get, it's almost developing like that throughout the day. So there's going to be a VWAP for every one of these, isn't there? And actually what's happening is we just join them up and it's very flat throughout the day. So you have that. You know, and as this thing is obviously developing throughout the day, you're going to get the VWAP in the middle, aren't you? So more and more volume is building, and ultimately through time, as market orders come in, the VWAP is just going to stay flat. Okay, so essentially what are we saying? Well, we're saying more than likely, because do you see what the VWAP allows us to do is it allows us to predict what type of day or week or month or year we're likely to have. Because if at the start of the day the VWAP is pretty flat, we already know that price is just doing this, right? So it's not in a trend is my point. It's not imbalanced. It's very balanced. Okay, so what did we actually say? And in fact, let me just redraw that, apologize. So I can just match it to obviously what you see here. You know, we talked about this during auction market theory, and the market is very balanced, right? What did we say in the probability distribution section? We said that one standard deviation, right, is just a measure of spread, you know, where we obviously did the variances, and then we average them, and then obviously we square root them, etc. I don't want to get into the maths too much, but you know, obviously I did ask you to watch 1.4 again, and I showed you how it's done to get one standard deviation. What that tells us is what? About 68%, but let's just round it up, about 70% of market orders fell within one standard deviation. Okay, now one thing that I've kind of briefly mentioned, but I'm just going to tell you here is all institutional investors, they're looking at one standard deviation, but they're also looking at two standard deviations. And I'll explain why that is because basically all the second standard deviation tells us is, so we calculate one standard deviation, right, either side of the mean, we multiply it by 2. What that does is it captures more of the data, and actually statistically all it does is it captures approximately, and I mentioned this in the last section, 2 standard deviation, 95%. And look, I understand some of you, not through any fault of your own, because it might be new to you. You're gonna obviously be thinking, oh my god, this is a lot. Maybe you are, maybe you're not. Look, don't worry about it. At the start of my career, even though I was a mathematician, for me to understand this in relation to markets and how markets were moving, like I said, I tried to be very perfect. So I had my sort of pitfalls that I fell into too. And it took me a long time. to understand this properly. So don't worry, I don't want you to necessarily get this straight away. I want to use this as a reference. So over the next few months you're trading the VWAP, I want you to really develop the understanding from this point of view that, okay, I understand now why investors are using the second standard deviation, because 95% of all data, market orders, heights, whatever it is, falls within the second standard deviation band. And I'm going to show you that in a second. Don't worry, we're going to get very practical in a moment, and this will make a lot of sense. But it's important I say this about the second standard deviation, because I don't want anyone to wonder and think, why are we using the second standard deviation band? I don't understand that. Basically, it's because 95% of the data, approximately, falls into here. What does that mean? That means that approximately 2.5% of the data falls outside of the, let me redraw that, falls outside of the band, the second standard deviation band, and 2.5% here, right? 2.5 plus 2.5 is 5, and then 95 is 100%. So my point is this: in a balanced environment where we have a nice shape, and we talked a lot about the shape, what's the probability of the market essentially printing market orders here? Peanuts, guys, 2.5%. What's the probability of the market sustaining a move in this region in a balanced environment? Guys, 2.5%. Why is that? Because only, not historically, but up until, well, it is historically, right? Up until that moment in time. So here, let's say you're at this moment in time. How much of the data has actually fallen in this region? 2.5%. So it's just the probability based on observations. And here, 2.5%. So can you see, basically, when this is happening, do I really want to be trading here? No, I don't. Because the chance of me staying within this region is very high. Do I want to be trading here? Yes, I do. Because the chance of me staying in this region is very low. There's barely any chance, based on all market orders up to that point, that I'm going to stay in this region for very long, right? There's a 2.5% chance. Those are good odds. I want to take those odds. I'm sure you do. So that's why people, when we go outside of the second standard deviation in a balanced environment, algorithms are fading it, fading it, fading it, fading it, fading it, fading it, okay? Why? Because probability is on their side. Why would you take a breakout trade in this environment, balanced environment? It's completely crazy. Because what's the chances, statistically anyway, based on market orders to that point, of this going in your favor? 2.5%. Would you rather take a 97.5% probability? You know, you hear a lot about guys talk about high probability trades. And I know I obviously do dismiss retail talk a lot. It's complete garbage, guys. Can you see this is what probability trading means? You know, it's like either you're taking a very high probability trade of reversion. Do you remember we did this on the volume profile in foundation course, where I said, oh, you know, we saw absorption and we saw heavy selling coming in this region, and I said, oh, I'm playing it back to the mean, to the VPOC, to the whatever, to the VWAP. I didn't call it the VWAP at the time. Can you see, guys? It's no different. You've been doing this in the foundation. Obviously, just didn't want to get into the statistics because it obviously would have been a lot, moving too fast. Now you're ready. You're in the pro section. We're moving you on. I want you to understand why I was fading the market. And remember, you saw this. Just don't get, this is my point, don't get thrown off just because it's a normal distribution and it's got all these percentages and stats, and don't worry too much about that, all right? We're not looking to become mathematicians. However, I have to be honest with you that obviously you're now an institutional investor. You will need to just have a very basic grasp of, don't just do things randomly, is my point, just because, oh, Envy told us to do this. No, I've always said question everything, have a basic understanding, and I hope this has given you a good understanding of why on a balanced day you're fading the typically the extremes which are defined as the second standard deviation. And we can talk a little bit about rhythm. Obviously we can see if the market keeps bumping its head just below, just below, just below, then it's okay. The rhythm then has changed. It's no longer the second standard deviation, and we can talk a little bit about that. But I just want you to understand that in probability terms, why so many institutional investors and algorithms and so on and so forth are looking at standard deviations, because it tells them in a balanced day, you know, I told you the standard deviation has this amazing property, but it's accurate when we have a balanced environment. And I talked a lot about this in 1.4 again. So you'll see why this can become a problem when we have an imbalanced day, because when we have an imbalanced day, what did I say? Market orders, you don't act like this, do you? You start to build volume at an edge, and what happens? Do you see this area starts to build volume and it no longer stays this shape? You start to get out of shape, and therefore you can't, these probabilities start changing. That's the problem, and we'll talk a little bit about that. But you know, again, I don't want you to be misled and think, oh my god, I need to understand this mathematics to a high level. You don't. Look, at the end of the day, just get the gist of it, that okay, within the first standard deviation is 70% is fair value. So obviously I can use that accordingly to decide if I'm going balanced, imbalanced, as I showed you in the market condition section. But in terms of fading the market, I've got a very high probability if I go even out further, because the second standard deviation captures what? I mean, first standard deviation is 70%. If I obviously look to increase the distance, and you saw this, the number of heights, the data, of course, in a bigger region, is going to be captured 95% of the data. All that means is there's a 95% probability. It's not guaranteed, but it's the best model we have of the world. Remember, I said it's by no means perfect, but it gives us a very good idea that more than likely going forward, because of what we've seen in the past, over the day, over the week, over the month, there's a 2.5% chance that we're going to stay in this region. Why is that? Because 95% of everything happened within the bands, okay? So obviously it's 2.5% this side, and it's 2.5% this side, all right? So essentially, hopefully that makes sense. Let's look at this as we would on an actual chart. All right, so let's go to the next slide, and then hopefully this will make a lot more sense to you. Okay, so now you can see this is actually crude oil. It's the actual crude oil chart. Don't worry about the color of these things. I'm going to talk about them. They're these Heikin Ashi candles. I don't use them, but I'm going to get you guys using them. They're going to be really helpful to you to visualize rhythm, and I used to use them a lot historically, because they, not because they have any magical properties, I really couldn't care less about any of that stuff. There's various reasons why I found these type of candles useful, and you know, obviously I'm trying to help you out, guys out. But now I don't use them. I don't even use candlesticks. I use just black lines, because obviously my understanding of rhythm has become obviously much more advanced over the years. But I think this will help you to develop an understanding. It will help you get into trades, and we'll talk more about that. My point is, don't worry too much about you know, the colors of these candles and stuff like that. Just notice how similar this is to what I was saying theoretically. Okay, so this is the actual crude oil market recently, and essentially it's just going up and down, right? Can you see? It's a balanced day, guys. Look at the profile. But the profile didn't look at that like that at the start of the day. Do you agree? The profile, we talked a bit about this in the last section, probably looked more like that. And at some stage, obviously we can see how the VWAP changed. Can you see it barely changed? Early on in the day, obviously a lot of market orders are coming in, and there's not much data, so it's going to be a bit volatile. But as things settle down very early on, look what happened. Okay, all that means is that the profile, as new orders came in, yeah, we had a few orders here, but not many. As soon as we came down here, it just moved up very quickly, and we started building much more here, much more here. So yeah, can you see we had some market orders increasing on this side, but generally the bulk of it was here. And then here again. Do you see the market just never went anywhere? Okay. So essentially, what have we got here? The second standard deviation is basically this area here. Can you see that is the second standard deviation? Okay. So what algorithm's doing early on in the day, they're establishing, say at this point, they'll know. Obviously, you won't be able to see all of this, but it's like that, right? So can you see the VWAP went up and then it came down? What does that tell us? Probably that, yeah, early on in the day we built some market orders here, but then we came down and we had a nice balanced profile. But what happened? Early on in the day the VWAP was there and then it shifted down as this came in and then it evened out, right? So you can see that there. That's why the VWAP is so useful. Because think about it, otherwise I would need to see this profile split out at that period, which is probably that bit. This, can you see that? This period here was probably that bit. This period here, then I need a separate profile with sort of both of them combined. Then I need it for when this part of the day happens. So I need a third profile. Can you see? How many profiles can you practically have? For me to know that the VWAP what? Probably at some stage was up here, then it moved down here, then it probably moved down here at one stage, which you can see here, and then it balanced out. And then the more we built market orders in the middle, balanced out. So it may have obviously early on fluctuated and then done this kind of thing. Can you see that? Same shape. But rather than me having to see so many different profiles, the VWAP just allows me to kind of see how the evolution of the day was happening. So I can make a prediction on, well, we've got a flat VWAP and we're just going around it, as in the profile's just building on a very balanced level. How should I trade this? And I'm not going to trade it as an imbalance, because it's not imbalanced. It's very balanced, isn't it? We already said the fair value, the one standard deviation. So what am I going to do? I'm going to look at the second standard deviation, which we actually have for us here. I'm going to take short positions, long positions. You see, this is where the rhythm comes in. And look, the task for you, just so you know, is you're not going to be listening to me and then that's it. We move on and talk more. No, your task is going to be identifying this on the real market. Okay, we're going to do it together, and then I want you to go away and do it. So it's very important that you understand this. Not only a market condition, balance, imbalance. Obviously, this is very balanced, but rhythm. What's the rhythm at the start of the day? Second standard deviation, second standard deviation, second standard deviation. Look, it changes. Something changes. You need to be able to identify. I talked a lot about this in the composite section where I said, guys, we have major edge over algorithms when we can start to apply logic, do things from a discretionary basis. I tell you, it's going to be difficult for an algorithm to identify these type of conditions in the way we can, almost a little bit from an analytical perspective. Obviously, where it's clearly obvious, they should be able to identify it. But at the same time, it's like, look here, I'll give you a good example, is we have massive edge because when you program a system, what do you say to it? Do you say, oh, when you touch the second standard deviation, I want you to consider that a reversion when you're a bit of a price away from it? Do you see what I mean? We can use a bit of logic and just say, well, what's the rhythm of the market? approximately. Right, those two were obvious, but look, it didn't quite touch it, but it's obvious. Pretty much at the second standard deviation, right? And here we can say, do you know what? We're starting to build a bit of volume here, right? Which you can see here. Maybe this market's not interested in actually going here. The rhythm's changing, okay? And then we revert back to second standard deviation. So my point is, we need to be aware at all times of day. I mean, to be fair, this would have been a much better example had, imagine that hadn't happened and the market just stopped in that region and turned around. That's why I say sometimes you got to understand the rhythm of the market, because in that scenario, you're having the rhythm as 2SD, 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 and then look, one first standard deviation, first standard deviation, first standard deviation, and back. So whilst okay, we overstretched in this circumstance, I just wanted you to see why I'm saying we need to kind of think about what's the rhythm of the balanced day. So imagine this price wasn't here. So my point is this, and imagine we were just doing this. I hope that's clearer what I'm trying to get at. Can you see the rhythm here is 1 SD? You see that? Whereas if we're doing pretty much what we've been doing on this day, I'm just going to draw it in myself. Can you see that? Different rhythm, guys. Second standard deviation, second standard deviation, second standard deviation. You know, in the market, and you'll notice this, the market has this rhythm to it. See, I've heard some guys, the way I was taught, rhythm in institutions was more about, you know, the size of this leg and then the side, comparing it, and even when we're going up like this, this leg should match that leg, should match that leg, and then retracement will be similar. And yeah, it's kind of useful, but I think a much better way of looking at rhythm is more in terms of the rhythm versus you know, the standard deviations and the VWAP, because I told you how powerful this thing is. It helps you to see how the day is developing, gives you massive clues and amazing trading opportunities. So if the rhythm is 2SD, we can look for fading opportunities. Okay, so we're going to do this, and actually don't worry, I've summarized all of this in a table for you, which you're going to see, which I call like a summary and a trade plan and whatever. So I've got all of this summarized. But look, at the end of the day, I just wanted you to see how institutions are approaching this, and a lot of algorithms are programmed to do this, to identify, is the VWAP flat? Okay, let's fade, let's fade, let's fade. Because what you'll see is when this fade fails, so let's say you build here and then obviously the profile shape starts to build here and we start to go imbalanced outside of the first standard deviation, and we start to build here, guys, it will pop, because a lot of algorithms and obviously locals, day traders, intraday investors, they'll be fading this market, and obviously they'll be bailing. So you know, that just goes to show how many people are using this type of analysis in institutions. So look, I think I've pretty much showed you what a balanced day looks like and why the VWAP is so powerful, because it's a good way of identifying a balanced day, a balanced week, a balanced month, a balanced year, and thinking about how can we trade this. Where's investors' perception of value? Well, it's clearly very centralized. So every time it goes out, they're going to go back to this fair value. And like I said, we've kind of done this already in the foundation section. We just didn't do it from a probability perspective, and also from a sort of developing value perspective. We kind of did, but we did it very much on the depth of market, and you didn't actually see any way of how the profile had developed over time, and that gives you clues as to not only how the next few minutes or hour may develop, like we saw in the depth of market, guys, how the whole rest of the week or the whole day or the month or the year will develop. So you'll see this, and the reason I keep saying this again and again is because when you see I go to do this on the week, month, year, and I introduce all of that to you, I'm not going to go through all of this again, all right? Because it's exactly the same. Obviously, I'm going to talk about balanced weeks, balanced months, but I'm not going to go through probability distributions and show you all of the stuff because I'm just going to assume you know it, obviously, because like I said, this applies to all types of VWAP analysis, okay? So let's move on to imbalanced days, theoretically and then in practice. Okay, so on an imbalanced day, let's just think about what's actually happening here. So on a balanced day, right, what's happening in the market? It's just obviously gyrating up and down, and market orders are developing, right? Again, you've seen this on the depth of market, nothing new. But what happens when you go imbalanced is you no longer within this fair value zone, right? And you start to do what? You can call it a breakout if you want. This is a true breakout where you start to build some market orders, buy market orders, get imbalanced, and you start to do this type of action. And you may just mess around here or whatever. But the point is, something's changed, right? Now, can you see what's happening here? Market orders. What's going to happen? You're going to develop volume in this region, okay? Can you see? Here you're going to have volume, here you're going to start getting volume building. And it could actually get quite thick around here. If you keep trading here, I know it's a terrible drawing, but you understand what I'm saying, right? The point is you're going to build a lot of volume. Something's changed, right? So you could, in theory, end up building a lot of volume in this region. And in fact, ultimately, you could even go on to build tons of volume. So my point is, look at the shape of this distribution now. You no longer, so all of this is filled up with volume. Can you see? Guys, you can't use the same probabilities. It doesn't work anymore. You no longer got a 2.5% chance up here, right? It's completely changed. In fact, your probabilities have shifted in the favor of going imbalanced, because now all of a sudden your distribution has done what? The mean, do you remember this? I talked about it. The VWAP has shifted up here. So you've almost got an entirely new distribution, okay? So this distribution almost becomes like that. Can you see that? You've gone imbalanced. You're building market orders. There's a whole lump of volume being built up here. So my point is, the distribution changes. All of these probabilities shift to this side, to the point where you can no longer say that I have a high probability. Because look, you're not, at the end of the day, this is why I say, look, you don't need to be a mathematician to get this. Think about it. If the price is just going up and down like that, you can just logically tell, all right, do you know what? Price has been going up and down, pretty good chance it's going to stay going up and down. If something goes like that and then it starts to do this, it's not the same, is it? Something has changed. This is almost shifted, almost entirely. Obviously, your balance distribution is now more like, do you see? It's completely changed. It's completely changed. Different kettle of fish, imbalanced day. Now, I talked about this a little bit in the theory section where I said, obviously we have different types of imbalance, and this comes down to rhythm again. Do you remember in the balance section, I just talked about it, sorry, a couple of slides ago, or one or two slides ago, where I said, if the market's moving like, close to the second standard deviation, we can say we'll fade the 2SD because the rhythm is a second standard deviation rhythm. Obviously, I said, and I'm not going to draw it again, but obviously, in fact, let's just draw it just for completion. if we've got the market doing this, it's not a second standard deviation rhythm, is it? And we shouldn't expect it to be. It's a first standard deviation.